Hi, I'm Madison Malone, and today we're discussing the tax implications of doing business with the world. And I'm joined by Divya, Ian, and Mark from BDO. Welcome. Divya, I think we should start by talking about tariffs, the big elephant in the room right now. Explain the situation currently for us and how it's impacting businesses at the moment, both negatively and positively.
Absolutely. So this is quite a topical topic at the moment. So if you look at exports from New Zealand market, the exports to America is quite high. It is second largest at the moment, and so obviously it impacts a lot of businesses. And it goes without saying that it has reduced the profit margin. People are skeptical about the demand of their product, competitiveness about their products in American market. But I guess if you put everything into a perspective of what's happening globally. So look at China, the import is 145%. Some of the Asian countries, it's between 11 to 55%. And if you look at New Zealand, it's on the lower end of the scale, it is 10%. And interestingly, I was talking to a couple of businesses, specifically in wine industry and food industry. And specifically, one business had a very interesting perspective. So they've looked at this 10% and broken that down into three components. And they're saying, okay, with 1/3, we'll try and negotiate with our suppliers and see if we can push down some costs to them. Another 1/3, they're doing a detailed profit analysis to see if they can absorb some of the costs and, still have a healthy profit. With another 1/3, they are looking at whether the customers can renegotiate the contracts and, with only a marginal increase in the price, is it going to be still sustainable? So I believe there are a couple of considerations. There are some immediate considerations and some long-term considerations. With immediate considerations, businesses need to look at their supply chain, look at whether there is opportunity to negotiate contracts with suppliers, look at opportunity to negotiate contracts with customers, do detailed analysis, forecast, and all of that. So impact analysis is important. Then I would say a more important piece is to understand what is the HS code under which they're exporting to US. That is a unique customs code under which you export to America or any other country in the world. And the tariff rate can be quite different depending on which HS code you export under. So if they are not using the right rate, using a more appropriate rate could give them a better answer. So that's one opportunity. Then looking at any concessions available, any exemptions available, can they apply for some concessions? Can they apply for duty drawback? So that's another opportunity.
Interesting. How about more longer term? What should businesses be thinking about in terms of their export strategy? Should they be looking to diversify, perhaps?
If you look at exports from New Zealand, what are the top 10 countries? Top 3 are obviously China, America, Australia, which is about 50% of exports. But if you go down the list, there are next 7 countries, which is Asia and ASEAN countries, and a bit to UK. That is about 20%. Now, looking at any alternative markets, have they tapped into the Asian market? And is there an opportunity there? And that might align with what's happening globally, because globally, there's a lot of change in the dynamics of trade between US and China, US and other Asian countries, because they have been hit by these exorbitant rates. New Zealand still has that advantage because we have 10% rate. So then I think it might align. So if they are looking for a better market to import from, then New Zealand will naturally fit into the whole piece, and, we can export to those countries. And definitely, understanding the consumer, understanding that market is quite important. With New Zealand, there are a couple of advantages. So New Zealand has got free trade agreement with a number of countries, including Asian countries and, some of the European countries. So looking at, is there an advantage where the products can be exported free of duty or at a lower tariff rate? That's a huge, huge opportunity. And also, I think New Zealand products are loved by consumers internationally. We can't win on price, but we win on premium and high quality products. So I think those are couple of advantages. So I think lastly, I would like to say that don't focus on what you can't control, focus on what you can control. And if you put everything in a perspective, I think you'll not only get through it, but you'll get through it quite successfully.
Thanks so much, Divya. Those are some amazing tips, and I especially love the optimism that you bring as well. Ian, for businesses that are thinking about going offshore who haven't yet, what are some questions that they should be asking themselves before they do?
Well, which country are you going to? what's the business model, all of those things. But from a tax point of view, a lot of it's about what structure do they need in that jurisdiction. And that will depend on the scale of operation they're looking for. Are they sending up a person just to promote some sales temporarily? Are they going to open an office? Are they buying a factory? Are they going to have goods in a warehouse? All of those, the facts of what the operation is going to look like is very important. Then you get into a stage, let's say you're getting to a stage where we want to establish a presence over there. We're not going to be trading through an independent agent or a third-party logistics supplier. We're going to have a presence there. So then it's, do we trade as an overseas company? That's called a branch of a New Zealand company. Or do we set up a company over there? And the challenges with some of that is it can create a double tax cost to them, which we can explain later on. But the starting point will be working out the legal structure. And in New Zealand, it's relatively easy to set up a company. Overseas jurisdictions, it's not so easy, and often it can cost a lot more money to get established properly. So they need to evaluate that position very, very carefully. And it's often important to get it right to begin with, knowing where they are going with that operation and what it's going to achieve, because overseas there'll be blockers to reorganizing if you don't get it right in the beginning. A capital gains tax, limitations on corporate reorganizations, maybe stamp duty on transferring shares if you haven't got it right. So planning and planning and planning is very important.
Yeah, as you mentioned, Ian, tax is complex here, let alone in other jurisdictions. Mark, can you take us deeper on those tax implications that businesses may face offshore?
Yeah, so thanks, Matt. I'll jump in at the deep end. So Ian's going through a process here, but I normally use a whiteboard for this, so you'll bear with me. So let's take the example, and good on you. You're going into Australia and you commercially need a company. So you set a company up and you go, fantastic. Headline corporate tax rate is 25%. We're only paying tax at 25%. From our perspective, it doesn't stop there. How do we get the money to your pocket? And if we flow this through, company makes money in Australia, pays 25% tax. It then pays a dividend back to New Zealand. And let's say the New Zealand shareholders are a company. 9 times out of 10, it probably will be. Won't pay any more tax at that point. Fantastic. But this is the kicker. This is the dilemma. From a New Zealand perspective, we have tax rules which are designed to prevent, ironically, double taxation, but not for this. In New Zealand, we have what we call an imputation credit regime. That refers to tax paid in New Zealand by a company. If the tax is paid in New Zealand by a company, then Maddie, when you pay a dividend to yourself, you get the benefit of that tax. But we didn't. We paid tax in Australia. So we don't have that benefit. So now we've paid 25 cents in the dollar in Australia. We've got 75 left. You're a 39% tax rate payer. You're going to pay another 39 on that 75. So your headline rate in Australia at 25 has now suddenly become an effective tax rate of over 50.
Well, that's then a lot of tax for me to pay in that event, Mark. So what are some things that I can do to mitigate that?
Okay, so a really good question, and everyone wants to know the answer to this. So the first thing you could do is you could say, I'm just going to bring everything back as a charge. So I'm going to leave Australia with no profit. So you could just bring it all back to New Zealand and say that's a management fee. So you could do that. That's fine, but you've got to work within the realms of our transfer pricing regime. So I'm chucking some terminology at you, but transfer pricing basically means you can only charge Australia for something that is real, something that is bona fide. So if I've got a head office function back in New Zealand that's providing a service to Australia, then New Zealand should receive value for that. So I can bring some money back pre-tax legitimately that way. So that's the first thing. The second thing that we like to do is we like to look at the financing structure. So how is Australia funding its operations? And if we just fund it all through equity, we haven't got any debt that we can charge interest. And interest is another way that we can get money back from Australia pre-tax. So Australia gets a deduction, income to New Zealand. We have to work through withholding tax. We'll leave that for another day. But that's another avenue that we can pursue. But again, we have backstops within legislation that says you can't have it all as debt. You've got to have a mixture of debt and equity within thresholds. Again, another day, Maddie. The last thing is that we can look at more complex structuring. We can look at what we call hybrids or transparent structures, which just allow everything to flow back to New Zealand. But that means we would have to change the structure in New Zealand as well. And then suddenly you might find, while you've got a tax-efficient structure, it's possibly not palatable commercially, more complex commercially, and it's just hard. But those are some of the things that we look at.
Ian, any other tips on how to keep things simple while also not having to pay too much tax in too many countries?
Sure. No, I'm a big fan of trying to keep it simple. You know, we don't want the tax dog to wag the commercial tail of the business. So if the business opportunity is good, we should make that. And a lot of companies we're not necessarily building it to pay dividends out to our shareholders. We're building it perhaps to grow a company that might be for a sale at some point in the future with a good operation. So Mark's absolutely right around the transfer pricing. Don't forget the goods that you're selling from New Zealand to that overseas jurisdiction. That's an area that falls into customs and tariffs as well, and the value that we put towards it. And really it's about understanding that structure, and you can spend a lot of time trying to find that transparent kind of hybrid entity and find it doesn't work, or it's too costly to run, or it's something they're not familiar with, because business owners want to run the business because they're better at running a business than doing the tax. So we don't want to give them a structure they can't use or can't understand correctly.
That's what we have all of you for, to figure out instead. Thank you so much, Mark, Ian and Divya. Appreciate your time and thoughts.